I guess to start off on the PE panel, as we all know, there are many flavors to PE. So I think what I was going to ask perhaps is for each panelist to introduce themselves and maybe give us a little bit a minute or two on what they do and perhaps how they're somewhat different than the other panelists sitting up here on the stage. So I think we could start maybe, Andrew, if it's all right, on the far side and work our way back down this way and get rolling.
Right. So my name is Andrew Garcia. I am a representative of a family office called Brentwood Shipping and Trading. Brentwood is the holding company of the Radziwill family, through which they are invested in the crude tanker market and the dry bulk market as both an owner and a operator. And they've had interests as well in LNG and other spaces. And what I think it was, as we were kind of pondering what private equity means, at this end of the table, we're really about as private as equity gets, in that we have a very long time horizon, and that while we're interested in owning physical assets, we also from time to time look at the capital markets as a way to partner with people who have expertises that are separate and different than ours to find access to other markets, as well as partner with financial people and financial institutions to help them, access those markets where we have a good understanding.
Luke Beltnick, I'm a partner with Castlelake. We are a private equity shop out of Minneapolis. At the end of the day, we're really asset investors, everything from shipping, obviously, real estate, aircraft, across the board. And a lot of it is distress, so it tends to be cyclicals. When things are going through a downturn, we'll look to get involved that or a special situation in nature, so it tends to be higher return, chasing equity type of returns by buying the asset. And it's either buying things directly or it's acquiring the asset indirectly by buying debt or securities backed by assets.
Alex Argyros, I'm with Axia Ventures Group. I run our investment banking division, so technically I'm not in private equity, but we are in the fortunate position to be working both with a lot of private equity and other capital providers that are looking to invest into shipping, but also looking at it from the other side, from operators that are looking to attract private equity capital or institutional capital more broadly. And that, as Brian alluded to, can take various different forms, whether it's assets, other securities, equity, and whether it's deploying or attracting capital. So there's different dynamics depending on what the underlying product and who is looking to do what here in this situation.
Regan, I'm an operating partner with Apollo Management, and Apollo invests and manages investment funds in both the private equity and credit-oriented vehicles. So the application to shipping is that essentially we can handle a lot of different types of deals with a lot of different investment criteria, and I would also say that we have the unique interest at times to actually own and manage assets, which I think might differentiate us from other equity providers, and we're very much in business today.
Interesting, very much in business today. I guess the question is, what's the appetite, gentlemen, in the markets today? I guess maybe we could start with Art and Andrew, and I asked you guys first, not to pick on you, but because I think you're both kind of relatively new to a certain extent to your organizations, which is indicative, I would think, of some kind of an appetite for shipping. And we keep hearing private equities dead in shipping, private equities going to exit shipping. Yet you're at two fantastic organizations that I would guess think differently.
I'll start. Well, one of the common themes for interest in shipping has always been liquidity. So I think one of the biggest problems that the industry has now is there's so little liquidity, which you keep hearing throughout the day, and that's a problem for some equity sources. But if you have a firm that manages a number of different types of funds where there's different criteria, different investment hurdles, you can be more opportunistic within different parts of the cycle. And I think that's where we are right now. So as a firm, we also recognize it's illiquid right now in most sectors, but things do change, and I think it's appropriate that you don't give up. If you have resources that have spent a lot of time to understand an industry and be comfortable operating within it, then it's important that you stay attuned to the changes in the industry, and they do happen quickly and sometimes without people anticipating it, and that's how we look at it. So across the equity landscape, we are interested to continue to buy assets, but that's of course always based on pricing and the particular deal. From a credit perspective, frankly, the investment hurdle for shipping is a lot lower right now. The expectation is lower, so you just have to be more flexible with matching particular deal flow to the investment funds that you're managing. So to be in the game, you have to stay very active, and then when opportunities present themselves, you can act. You can't begin from scratch when the opportunities turn, because by the time you're ready to invest, you'll be too late necessarily. So that's why we stay very much engaged and very invested across the shipping industry.
For me to claim that I'm joining an organization that is new to shipping or recently interested in shipping would be incorrect. They've been involved in the space for generations, and it's in the blood. I would say that the opportunity that was created for me, or why they would look to somebody who spent the last 15 years operating in the capital markets in a more traditional buy-side position, is that a recognition that there is an evolution in shipping, and that as a consequence of increased financial investment in the space, increased financial sophistication, increased participation by multiple people, and an evolution of banking relationships, regulatory environments, that there's going to be a convergence between traditional private family ship management and institutional standards and institutional management and the way of thinking about returns and partnership and reporting. And one of the things that we've looked to do is take advantage of what we think is a unique situation that comes around generationally, where you have very low asset prices in a cyclical business. You have a lack of capital available to pursue those. You have a lack of confidence on the part of traditional distressed investors, because some of them may have become involved a little bit too early, or may have seen the missteps of some of their competitors and decided to take a lesson from that and try to be proactive in creating opportunities for us to put our own capital to work, and to the extent that there are like-minded investors, finding an opportunity for them to put their capital to work alongside us.
And if I may add, Brian, I think, we hear a lot about, private equity and shipping being permanently divorced, but I think there's always availability of capital, just a matter of, for what type of situations, under what structures, at what cost, and how much of it is available. So I think the bar in all of those things has gone up substantially from where it was before. But for good opportunities, there's always availability of capital under certain terms and conditions and under certain structures.
Right. Well, I want to stick on the generational cyclicality, perhaps. Luke, are you guys still actively looking in the market? Are there opportunities that you guys see out there? I think there will be opportunities in the next, say, 12 to 18 months to pick up on some of these really low asset values that we're hearing.
Yeah, I think like Art said, you have to do the work and be ready when the opportunities come along. We did a deal in the fourth quarter after probably 4 or 5 years of speaking to the German banks, we were finally able to get a deal done for 4 vessels. And so that's an example where hanging around the hoop, it took a long time when we finally found stuff to do. So for the right situations, we and I think some of our competitors are definitely there. It's just, we've seen it's tough with some of the sectors for us to get comfortable with, for reasons that have been articulated pretty heavily here today. But in the right situations and sectors where we think has a future and the order book isn't too high, we'll definitely get involved.
Right. Well, you mentioned Germany. Interestingly enough, several of us came back from Hamburg a couple of weeks ago, and I think it would be fair to say that capitulation would be a word to describe that market currently. You mentioned that something may have happened with you guys there recently. I was just wondering if the panelists have a view on whether or not the situation is finally so bad in Germany that maybe there'll be consolidation and/or acquisitions out of that market in the near future, more than there have been.
It sounded great 5 years ago, and it still sounds great today. There just hasn't been that much. It is about liquidity. You've got a huge disconnect in value in Germany between the assets and the debt. So managing through the debt continues to be what needs to happen. It has happened slowly, and that's always a good thing, because that's really all we need, is a stimulus to reset the cost basis. And when we saw that in, let's say, the tanker industry 2 and 3 years ago, when banks were selling loans on a frequent basis for a period of time, new investors were able to come in and reset their cost basis, inject enthusiasm, if not only capital, but some motivation to trade. And that was a stimulus in the market. We haven't really seen that yet from Germany in any large scale, but it has happened to some degree. We were involved in one deal that's working very well and created that liquidity, and we just need more of it. So I think we have to be patient. So it's not going to turn tomorrow, but I think we have to be patient, and hopefully it continues.
And I think it's quite similar to what we heard before about China on the tanker panel, how it's, maybe growing at lower paces, but off of a much bigger pace. It's kind of the opposite here. I think the rate of increase of situations that are coming out of Germany has increased, but it's off of a very small base. So I think we're still at the very early stages. I think there's a lot to do there with regulators and how they view banks and how they, they impose certain things on banks. It has to do with how banks have actually marked their positions in their books and how much ability and capital they have in order to be able to reset the cost base, as Art very correct pointed out. We don't feel that we've seen nearly enough of that yet, and I would expect that this is going to increase to actual absolute numbers that are a lot larger than what we've seen to date.
Well,
Yeah, just to follow up on that, I think until the German regulators capitulate, you're never going to see a capitulation because the banks own it all. They're just not selling.
Well, that's the exact next topic that I was hoping to jump onto, which is banks. Obviously, a big component of many of your investments is financing. Is there financing out there? What are you guys seeing? I don't know who wants to take a stab at that first. Luke, Lard?
Yeah, I can go first. We've definitely seen the bank financing tighten up from where it was a few years ago. It's still available. It's just, I think there's less aggressiveness based on what's happened with, particularly on the dry and probably some on the container side, and the banks probably not having as much confidence from up above to invest on the same terms we used to get. So it's there, but it's not as easy as it used to be.
Definitely not as easy as it used to be, but there is still some there. And what we've seen previously is when the primary banks for a period of time begin to get much more passive towards interest in shipping, new banks or re-emerging banks in shipping find the thesis and get back into business. So I don't think that the lack of ship financing will stay poor forever. It just has to go through its cycle, and then it will come back. So it might hopefully be short-lived, but right now it's quite tight, and it's not nearly as available with the terms. And that is a big driver of the shipping industry, is access to reasonably priced large leverage financing. So we have to get that back, but it is tight right now.
Even for more profitable sectors and assets?
I would say that across the board, there's lower availability of capital from banks in the traditional sense of the word. We are seeing the early stages of shadow banks emerge in this space and fill that gap to a certain extent. But I think that's pretty much the same across different sectors, obviously with different degrees in dry and container than in tankers. But even in tankers, we see the banks being a lot more conservative, and that's where perhaps also the regulation is working the opposite direction, whereby it's becoming more expensive and more difficult for banks to underwrite new loans. So I would agree with actually what Art said. It's out there, but it's not as much again, and it's not as cheap as it used to be.
All right. Hopefully, it's always then darkest before the dawn, and we'll see the banks starting to reemerge into the market, help you guys get some good deals put together. So I guess, Art, that leads to the question, are there specific developments that you might be looking for in 2016 that might create a new wave of private equity investments, in the next 12 months or so?
Well, I mean, new wave, I'm not so sure things can work that quickly, but in general, what we're looking at, and I will say that we have the advantage of a very large asset base, so we can work within a wider range of potential financial structures to finance a shipping deal, and that's an advantage, and we've taken the time to create that. But the cost of shipping is going up for most ship owners. It just is. When you have the least expensive cost of financing dry up, if it's going to be replaced, it's going to be replaced with more expensive capital. That is represented by firms like Apollo, who have different sources, but the types of structures that we are interested in are not as risk sensitive as they used to be, meaning that right now would prefer some kind of contracted employment for 3, 4, 5 years or longer. So I think the structures are less risk sensitive, meaning that we would like to have contracted cash flows. But there are many opportunities to do that, and it's just a matter of staying in the game and waiting for certain opportunities to avail themselves. As other financing sources are not available, deal flow happens, and we're ready to pounce when that happens.
All right, so it sounds to me, perhaps, and correct me if I'm misreading this, presently then there probably isn't much bank financing to help out private equity, which would therefore could gum up the works a bit, at least for the next 12 months or so. Any views on that, on the panel?
I mean, I think it's definitely the case in terms of, building from scratch a new capital structure. I mean, just before this panel, we heard the view that, where most of the opportunities may lie is by investing in already public companies in the tanker space, for example, which already have inherent bank financing in place in a lot of situations. So, yes, it's definitely not making things easier, but I don't think that that's the reason or the gating item in terms of private equity re-engaging or engaging in a more kind of forceful way or not. I think it just changes the opportunity set and how people analyze those opportunities, and you just have to price that in effectively. Just makes it a little bit more expensive, as Art said.
I also think you can't ignore that there is bank financing being made available to companies that normally wouldn't be eligible to receive that. And these are companies that are struggling in the current environment with their minimum maintenance collateral obligations, with their minimum liquidity covenants, and where the banks are giving them, to some extent, as we have read in the public market, sort of holidays and forbearances in exchange for extending that runway. So rather than having a flushing of that asset and a reset of price and another buyer coming in and attaching maybe a new banknote to it, at new price, that bank is simply re-underwriting it with an operator and a set of investors that they already know. So that takes some capacity out, and with the banks no longer being paid their principal repayment on the same schedule and having tighter restrictions, it also takes out some of the capital that would be available for them to lend to that space. So there's sort of a silent financing environment that's growing there as well. When you ask about 2016 and what we need to see, I think that one of the things that we need to see is a follow through on this sort of pending recirculation of some of the hung companies in the financing environment. We have this sort of standstill between let's call it zombie companies and the financiers of them, whether they're private equity backed, whether they're privately held. And, at some point, there needs to be a reset where new capital comes in, where new prices are established. And I think we're coming towards an end, where you can have this market that they can say a market doesn't exist because where the buyer wants to sell where the seller wants to sell and the buyer wants to buy is too far apart. At some point, we're going to get to the point where a transaction is going to happen and we're going to know where that market is. And I think that in itself will be cathartic and help bring in some new investors at that point in time. But until we see it, as long as we stay in this standoff, I think that you'll see people stay on the sidelines because they're going to be waiting for that event to happen. They're going to be concerned about committing to the market before they see an event like that.
Right. Well, staying on present deals, but hopefully the flip side, I'm curious then if the panelists have any views on deals that were executed nicely already that are currently in the market, exclusive of principal, I guess we shouldn't speak about, but are there other principals in the markets presently that we think have been executed very well and that we'll probably see encourage others to dip their toes back into the markets in the near future?
I'd prefer not really to speak about any specific deals. That wouldn't be fair. So, I mean, what's not going to happen is new equity sources backing new buildings. I think that's one lesson that people have learned, and that's a very good thing. So the investment thesis that you can do something extremely different in commodity shipping, you know, that's just not the case. It's a fairly simple business, simple industry, supply and demand oriented. Demand generally recovers in almost all the commodities that we ship, and it's not bad in some instances, and it can be very, very strong. And our earnings capability is only limited by the amount of supply of ships. So the fact that there's been very few new building orders in the last 4, 5, 6 months in any sector, it's a very good thing. So ultimately, I think that's going to be the best deal that's done, is we don't order a lot more ships, and eventually the markets will recover.
Yeah, I mean, like Art, I'll try not to answer the question, but I'll just say, I'll just say that hopefully the best deals are deals that are yet to come. So.
Yeah, just to add on to that too, hopefully the best deals are yet to come. I think some of the best deals never get announced. They're private and you're never going to hear about them. That's been our experience at least.
My view are the best deals are the ones that none of us want to celebrate. And those are the people who, at the end of 2015, made the difficult decision to scrap older tonnage when scrap prices were 2 to 3 times higher than they are today. Those are the people who got ahead of liquidity windows and made the painful decision to sell assets in order to raise money and extend their liquidity window, even though the market got a lot tougher. Those are the people that were proactive about shoring up their balance sheets and trying to protect shareholders in the public market. At each one of those times, I think the market generally didn't celebrate that as a victory. It looked at it as a thing of weakness or a sign of failure. But those were tough decisions to make at the time, and the people that did it, I think, deserve some credit. I think that the victories that we'll celebrate going forward are those people who, in a market that isn't celebrating management teams necessarily for doing the right thing, for controlling expenses, for having a moderate amount of leverage on their balance sheet, for focusing on returning capital to shareholders in a prudent manner, either through stock repurchases or through a prudent dividend policy, and not growing for growth's sake at the dilution of other shareholders. I think when we look back a year from now, those are going to be the best deals, and those are going to be the people that we talk about in hindsight.
Well, I think that's what Wilbur Ross might have been saying, and that was actually one of the next topics I was hoping to hit on as well. So I guess from the others, it sounds like perhaps there might not be many asset deals in the immediate future in play, at least none that might be publicly announced. So is the view then that equities is really the place to be looking? I guess Alex is a good person to start with on that.
I think it's a little bit hard to generalize with this question because when you look at different sectors, I think the answer can vary wildly. I wouldn't preclude asset deals. I think most of the asset deals that will happen will either kind of inherit financing, like Andrew was mentioning before, or people are going to have to assume that they are unlevered deals or very low leverage deals and make sure that the numbers work on that basis. But I do think that in some sectors, it may make more sense to go more towards existing outfits and kind of switching out the old ownership with new ownership, maybe taking some companies private, it may make sense, or partnering with the banks where a lot of the problems are currently resident. And I would argue that, in a lot of cases, the banks lending into shipping, or some banks lending into shipping rather, are in a lot more dire need of capital and liquidity than a lot of the ship owners out there are. So I think that, going forward, I just think we're going to see much fewer deals, but over a much wider spectrum in terms of the types of deals we're going to be seeing.
Right. Okay. Any other thoughts on that, or move on? I guess with the current investments then, and with limited partners, I'm curious as to their views on the current markets and where you are. I guess, Luke, maybe you're a good person to start with on this particular question. What are your limited partners' views on the current markets and where you are?
Yeah, I know just from having one-off conversations with our LPs that, not surprisingly, they're invested in other distressed investors or asset investors who have shipping exposure, a lot of which was in dry bulk. And there's been a lot of people who have been burned by it. I remember having a conversation a little over a year ago with one of our LPs that was looking at making a specific investment in a group looking to raise just a dry bulk shipping fund, and I told them not to do it, and they did it, and you can imagine how that turned out. So there's, I'm interested in what other people here have to say too, but there's been a lot of LPs that have been burned by it, but I think it probably depends on how much exposure they had across it to how much pain there's been.
The fact that shipping is so critical to the world economy, we forget that when earnings are down and the industry is in distress. It will come back, and it is such a necessary component of the world economy that it always has to be investable because the world can't exist without it. From an industry performance standpoint, we do oversupply. So we're guilty of our own devices, and once we correct those and get our particular markets in balance, it will become more investable. It's a very different circumstance than we've seen before, where you get, for example, in the tanker equities, that the companies are trading at significant discounts to NAV. So do you buy an asset or do you buy equity is a very difficult question right now. It should be more in balance. So we need to increase the liquidity dramatically for that to be a more rational investment for most people. But ultimately, the shipping industry will prevail because it is so critical to the world economy in every sector of shipping. We just have to get our industry sector balance correct, and then it will become more investable again.
And I think that a lot of things we're talking about are exactly the things that are going to make it more investable. So, the lack of cheap and ample bank financing, the fact that, a lot of investors are, trigger shy now in terms of entering shipping, the fact that a lot of operators are under a lot of duress, all those things just decrease the probability of having massive ordering and messing up that side of the equation again. Because as we've heard time and time again, the demand is relatively predictable and relatively stable. Yes, there's fluctuations and things change, but it's something that you can reasonably predict within a margin of error. What can completely kill an investment is if all of a sudden between the time you invested and the time you're exiting that investment, there's another 100% of the fleet being delivered or being ordered, and that's something which has a lot more to do with psychology. And it's driven in a big degree from availability of capital or perceived availability of capital when deliveries are going to be starting to hit. So if you don't have those components there, I think people are so much less likely to go on an ordering spree, especially a speculative one.
All right. So part of the takeaway, I'm reading too far into this, though, is perhaps 12 months from now, financial institutions start lending a little bit more because certain various segments have leveled out a bit. We have less new building ordering going on. That tied in with a conversation I often have with my overseas partners is they're just flabbergasted with the amount of money that sits on the U.S. Side here in private equity. Is there an opportunity at some point for this consolidation that we hear about over and over again in shipping over the years to happen if and when all the parts are in the right place? Andrew, I see you're laughing there, so maybe we could start off with you on that one.
I used to be a big believer in the roll-up and consolidation of shipping. I think that there is a need for some rationalization of market share and for some concentration that we don't need to have especially in markets such as the dry bulk market, such fragmented ownership. However, the hurdles towards integration are very high, and the barriers to entry for people to enter are very low. So while I think that it's a market that would benefit from it, I'm skeptical that we will see in the near term a significant change in market structure, especially in dry bulk and in some of those spaces.
Yeah, and just to add on to that, if it is, it's certainly not going to be led by private equity. Going back to power markets and telecom, in the early 2000s and everything since, every industry I've been in, when private equity gets involved or distressed investors, hedge funds, there's always going to be this big roll-up strategy, and I've never seen it happen because private equity guys cannot play nice together and agree on what each other's assets are worth.
Then add shipping guys to the equation. A little bit of vessel values, two different brokers, and it's a fun time.
There's a lot of, desire in what people would want to see happen and what is likely to happen. So all I can say is I hope that we'll see consolidation. I'm not confident that we will see it. And consolidation is not just about economies of scale. It's not about, cost rationalization, but it's also about controlling a lot of the egos and having more rational decision making. You would hope that once you have a more concentrated industry, you can transition into a more or somewhat of a more stable cash flow environment as well, where you can have longer term charters that you can count on, and that allows, Art and the like to build transactions like the ones they're looking to, but also it allows for more rational behavior when it comes to ordering or scrapping or how they manage the vessels. It's not just about the economics of the vessel itself.
One place where I am more optimistic about consolidation, though, and I shouldn't leave this out, is I do think from the commercial management side that there is a benefit from consolidation, and we're seeing it through the efforts of some of the people that I work with at CTM. You're seeing, with the Supermax RSA, and they're able to get to economies of scale there, and through doing it on a way that allows it to be very cost effective for owners relative to running the business themselves, they've had traction, and through the efforts of some of the largest dry bulk Capesize owners, we've seen Capesize chartering, and you've seen Golden Ocean and CTM and Star Bulk and Bocimar come together and put a partnership together. And maybe it takes a devastating market like this to get guys to want to work in unity. But I do think that on the commercial side, there's a tremendous amount of economies of scale, and there's information advantage that can be gathered because you're in a market where a lot of people are competing against each other right now, and the weakest hand sets the price for the market. And when they can kind of unionize and work together, they help spread it, be able to strengthen that hand and try to work for better prices. So I am optimistic that maybe on the ship ownership side, we may not see huge consolidation. I do think that some of the weak markets that we're seeing will see concentration on the commercial side, and you may see some benefits of economies of scale there.
Right. Well, it looks like I only have about time for about one more question, maybe. And I guess with respect to the current investments, Luke, I guess, how are you viewing exit strategies with respect to your current investments?
I think that's the biggest issue we face going forward. Most of our exposure has been in LR1 product tankers, so we've been fortunate in that it's been a successful investment. The problem we have now is we never came into this thinking that the IPO route was going to be our exit, but it was always a possibility, as well as just selling off the assets at some point, given the markets. Right now, there's no clear path what the exit is going to be. So while we're opportunistic and open to anything, it's not clear at this point when or how we'll exit.
Right, thanks. Well, I guess if Panelists had any other thoughts or views of what we've been talking about for the past, say, 38 minutes, please feel free to interject now. Otherwise, I'll open it up to the floor. We've got 3 minutes for questions, if anybody has any questions. No questions, you answered them all. So I guess I'll ask one more question then if the audience doesn't have any. In the next 12 to 18 months then, I guess maybe since we started with Andrew before, maybe Art, if we could start with you and work our way down then. Tanker, bulker, and containers over the next 12 to 18 months, positive, negative views for each sector, if I may? You don't have to answer that one either, though.
It's all about supply. In sectors where there's rational supply, the earnings outlook will be good because the demand for the commodity will save the day, but you got to get supply correct. So I think it's important to understand what the supply sector is in each, supply side is on each sector, and that can be the basis for beginning a view on the sector. Other than that, let's let someone else handle it.
What do you view with respect to the supply in the various sectors? No, down to Alex.
Okay. Look, I think it's fairly well established what the supply is going to be for each of the sectors. The key question remains, it's clear what the contracted supply is. I mean, the question that remains is how much of that gets delivered, and is there another ordering bench around the corner? I think the latter is easier to answer for the various reasons that we mentioned before. I think it's less likely to see that than it is than it was 3 years ago because of the lack of some of the tools that are necessary for that. So I think we're better off in terms of that. Then in terms of slippage, I think obviously it's natural to see a little bit more of that in sectors that are under duress versus other sectors. But I think through history has taught us that just looking at cold order book numbers is not going to get you very far. You need to go a few layers below that.
Yeah, I was hoping time would run out before I had to answer that, but it didn't happen. I mean, listen, I don't really have a view on the next 18 months, to be honest. We tend to look a little bit further into the future in that, and if we could guess 18-month views, would be doing something else. So I don't have anything in particular.
I would say that, I think we're entering into a very interesting point in time in the dry bulk market. Asset values are extremely low. Commodities do need to move. Although we have big supply-demand questions that remain to be answered. But we are very intrigued by the space, and we think it's interesting, and therefore it's a place that we're keenly focused on, and we think that there'll be tremendous opportunity, whether it's 18 months, 36 months, or 5 years. We think if you have a long enough time horizon and stable capital base, that there'll be money to be made there. I think that crude market is interesting from the cash flow today. I think it's a unique and perplexing situation where you have stable earnings and declining asset prices. And I think that people will be pleasantly surprised by how robust earnings remain for a period of time as they come down. But it's also a unique market. I'm not close enough to containers at this moment to comment.
Thank you for redeeming me with that answer, Andrew. And for fear of asking another thud of a question like that, we're out of time. Thank you very much for your time.
This is a very important event. It brings together investors, companies, capital providers, service providers in the area. It's one of the 2 times a year, or 3 times a year that people are able to get together in New York, share thoughts, share ideas, and network. I think that it's a time for us to think about being disciplined, about building and capacity in the space and rationalizing capacity so that people can work together to create a more sustainable environment than what we've had in the past.
And Castlelake is a great forum to get everyone across the industry, everything from the financing to the operating and the banking sectors together to share ideas and get the latest information together in one place.